thinking about the impact now of anything Wall Street Bets, the short squeeze, GameStop, etc., it's really a sign of exuberance in the markets now. We've got a lot of retail investors that are starting to control share prices, which is a big concern. But the underlying concern here is, where are the markets now? For a lot of investors, particularly retail investors, it seems pretty easy. You could have put your money almost anywhere in any growth type of company in 2020 and you would have done exceptionally well. So for us, when we think about all this, what this means, the first thing is that it absolutely has to come back to fundamentals. GameStop, as a traditional example, as we all know, was not a great business. Obviously, they were on the wrong side of change if we think about online gaming disrupting them. Yet the stock was obviously up materially over a period of 2 or 3 weeks. If you look at that share price chart now, the stock's down about 85% since its highs. So that firstly is our core belief. You have to focus on fundamentals regardless of how frothy the markets or the sentiment is changing in front of you. But more broadly, how we would think about that in the context of the biggest question that people are asking and should be asking is, are we in a bubble? And when we think about that question right now, one of the things that we're acknowledging is that even if we are in a bubble, there's a very big difference between being in the early or late stages of a bubble. I think a really incredible point here is Alan Greenspan made the quote or coined the phrase irrational exuberance back in 1996 when things felt pretty frothy. There was another 3 or 4 years until we really felt the tech bubble burst from that point, and a lot of upside to be made there. So that's one of the reasons when we think about this that we're really trying to be a little bit more neutral or balanced in the portfolio now, recognizing that there is extreme positive sentiment in markets, but there is quite the likely chance that markets continue to go some way from here. So we don't want to be overly defensive, but obviously don't want to sort of buy into the momentum too much and play offense either. Is there a potential that this bubble could burst at any time is the key question. And we don't think that that's likely where we are right now. When you think about it, a lot of people are obsessed with the average multiple, say, on the S&P of around 16 times, and we're trading closer to around 23 times now. The big thing here is that this is fundamentally driven by the cost of money or interest rates, which are incredibly cheap. Everyone knows that, but when you think about the alternatives for assets in the world, are you willing to take your cash and park it, or take your equity exposure and park that in cash right now? Highly unlikely, because equity is still providing a pretty decent yield. If you think about 23, 24 times earnings, that's about a 4% equity yield, which is about a 4% premium to what people can get on cash today. In a traditional market, if the markets are trading at 16 times and cash rates are at 2%, that's about a 6% earnings yield on equities above 2% cash yield. We still have that same equity risk premium. So we still think that that's underpinning markets where we are currently, but there are within sectors or within some components, areas that we're a little bit more cautious. So some of these mid-cap or smaller cap software companies, some of them not even trading on earnings, but trading on levels of 30 times sales, that's areas of the market that we're tending to avoid at the moment. What's the most exciting unknown company in our portfolio? Well, we have a small German healthcare company that I would wager most people haven't heard of, called Evotec. This is a company that is not only one of our biggest positions in the portfolio, but it's also our biggest global bet in healthcare. So Evotec, what they actually do, as I mentioned, a small company in Germany, but they basically manage the full pipeline of outsourcing for large pharmaceutical companies. So if you want someone to help you with your R&D, to get your drug through the pipeline of approvals, to even manufacture that drug, they are a one-stop shop for this. So this is a very strong business. So when we think about the global demand for healthcare with an aging population, when we think about some of the new technology with drugs that's driving stronger drug volumes as well, they're positively disposed to this. That sort of addressable market in whole is growing about 6% per annum, but Evotec's been able to grow their business by more than 20% per annum. So they're taking market share. They significantly cut down the timeline to get a drug to market, which is why a lot of large-scale pharmaceutical companies want to use them. But what's more exciting about Evotec to us is they don't just have this outsourcing business, they're actually choosing to not maximize near-term profits and reinvest all that positive cash flow into an innovation pipeline. So rather than just being the outsourcing partner, they're now actually buying into and being a partner in the pipeline with some of these large pharmaceutical companies. What that means is that they actually earn upside in terms of the royalties that they can have, the milestone payments they can have if these drugs are successful. And we think about that business, the market isn't even valuing that. And we think that the value of that business could be upwards of around half the current market cap of Evotech. For a business that in its own contract outsourcing business in its own right is actually an amazing business, there's a whole nother amazing value creation there on the side.